Good morning and Happy New Year, everyone. It is Monday, January 6th. I hope you all enjoyed your holidays and had some nice time away with your families. We are now ready to get back to the markets and get ready to trade this. So, do you believe in Santa rallies? That Santa is the one bringing the rallies to the markets, or do you understand that this is a business and the commercial side is creating their own agenda and their own business model? We have a lot of catching up to do after the break that we had during the holidays, but I want to know, were you ready to buy the dip last week? Today, we're going to review the ES and NQ to get ready for the first full week of trading. Remember that there is a market closure on Thursday, and we have a lot of data coming out as well. A quick reminder before we get started is that derivatives trading is inherently risky, and past performance is not indicative of future returns. We laid out in the video after this FOMC day here what was causing this whole move that everybody started panicking about, that the bull market was over, and gave you the answers from a business perspective. That still hasn't changed. The risk window now for this to materialize into further downside is beginning to close. And during the last 2 weeks, we had a light calendar with no real data, no real reason to engage around the holidays during condensed time in the markets as volume gets pulled away with traders stepping away. And now this week, we have lots of data as well as a condensed week. So the market makers have their goal to get back to their line in the sand. We tell you this time and time again ahead of major data that that's where they want to be. And our line in the sand was 60.23. We stayed under it to accumulate a position. Now we're back over it. And now we are back into risk compressing mode ahead of all the major data, especially for NFP on Friday. And that is where market makers are best protected. So all of this big up and down these last couple weeks has just been designed for the commercials to cover that short position we've mentioned on our COT report the last few weeks. They covered half of that in the week before Christmas, and today we'll get the final numbers to see how much they are still net short, if at all, at this point. They covered over 70,000 contracts in the week before Christmas, and that's what this move down was for. It's to give them the position to buy back to de-risk their books into the end of the year and make everything line up. And if you learn to follow the flows and follow the money and who's really controlling this market, you can piggyback off of that and give yourself a much bigger advantage instead of buying into all of the narratives. So if we look at what's happened in our recent trading session here, we're inside our rotational zone from our COT between 59.53 and 60.80, and we are in a markup right now. So we had our breakout of Friday's range and of last week's lower, most of the distribution, and really the lower edge of this last couple of weeks since FOMC, and now we are making our big push up in the overnight. We went over this with students on Saturday, why this was likely to happen for a big markup in Globex today, as well as the price action to expect coming into the week. And we are right now over prior day's value area and prior day's range. We're going to be opening on a gap. So we will watch for some kind of move when the cash index opens to pull back and begin to fill some of that. And then see where the turning point is. And we'll show our levels here in just a little bit. Commercials still, again, from a COT standpoint, are still net short. We'll wait for our data that comes out today at the close, and we will post a COT video as well for you guys to get caught up there. Market makers now are out of risk absorbing mode and into risk compression mode, which is where they want to be ahead of key data points. And so while we could chop around our 60.23 area, and again, that level does move throughout the day. If you want access to those tools, check out our courses and our Discord offerings to see where we can help you best in understanding this. But as of pre-market, that's at 60.23. And we will likely stay above that for the week. If we do get below that, we will see us back above that before NFP on Friday. Market makers like to be in risk compressing mode, so they have less risk. It's the same thing we had on FOMC. We stayed in risk compressing mode this entire week, kept bouncing at it, and then finally, once the FOMC came out, then they could let that go, but they don't want to be caught off guard ahead of the data. And fund managers made a big change at the end of last year, where they cut about 20% of their exposure, and now they're only about two-thirds invested, which the last times that we've seen it this low was October of 2023. And then this year, during January's pullback, or I guess 2024, January's pullback, April of 2024, as we went into April 19th, and then August 5th. Those were all times when our fund managers were around the 60 to 70% invested. And again, those were market bottoms as they had a lot of capital to deploy. Nothing from a macro perspective at this moment has changed. We'll see when the policies come out for the new administration, if anything jolts the markets at all. But for the time being, that is unlikely. And so we are getting signals that fund managers have capital to bring into the market, which again will support more of this move. So they panicked out as everybody else did, and now they have cash to deploy, and they're going to end up chasing performance to put on their prospectus to send out to their clients. Our systematics are buyers today between 59.44 and 60.31. They become bigger sellers at 60.63, kind of neutral sellers. This will all kind of wash itself out between 59.14 and 60.63. So we have a lot of buying that's going to come in and support the market up until that 60.63. That's where then we can look for resistance to begin coming into the market. If you look at the VIX, if you use that at all, it's still elevated, but it's beginning to break down. If you want those levels, we will give those out to our subscribers in Discord for your key areas to watch today there. And for our price action expectations today, now we are looking for between 59.48 and 60.27 to be our rotational zone, with our line in the sand just at the top edge of our rotational zone here. If we get over the top of our rotational zone, our first target is 60.51, with our pivot at 60.60, and then our end target at 60.82. If we stay in our rotational zone, our major pivot is at 59.74, with other references stacking up. Major one would be 59.92 to pay attention to, as well as 59.60. And if we happen to see a big move down, which would be our least likely scenario given where we are, even a full day's range wouldn't break our lower end. But if something comes out under 59.50, our pivot is 59.33 with a target of 59.05. Now, for those that do trade the NASDAQ and like to trade a little more volatile product, we're seeing similar structure as well after the FOMC markdown and now accumulation in this range. Our price action today on the NASDAQ that we're going to look at will be rotational from 21,302 to 21,680. Inside of there, your pivot is at 520. Which is right where Friday's point of control and our Globex time point of control are both lining up. So that is the major area that we have. If we get over 21,680, our pivot is right here at 21,751, where Globex high is right now. And you can see our large position here. And that actually just updated as we saw another $500 million in capital get deployed right here. If you were able to see that, this bar started here, and now we saw $500 million more come in. So if we can get over this large volume piece at this 21,769 half, then we'll make our move up to 21,886 with an end target of 21,956 today. That's going to be our roadmap for the NQ. Inside of here, if we can't get over our pivot, we will look to return under our rotational level for a short down to a potential gap fill. But remember, today there's a lot of reasons that we have flows coming in to look long, and those fund managers have that capital to deploy now for the year, and we have rebalancing coming in. So lots of factors at play. on our financial calendar for the week, we have JOLTS tomorrow, ADP on Wednesday, and NFP on Friday. So lots of jobs reports here. And remember, on these key data points, there is a price action pattern that you can expect as people buy their insurance and then have to cover that back, selling back that insurance, and then the metrics that the insurance providers use when they're selling, and then what they do to protect themselves as well, to lock in some profits. And if you want to know that pattern, go back to prior videos or wait until after this week. We would do go over this continuously with students in our courses, but there are business metrics to all of this. So this year, make a resolution to understand the business side of the market to give yourself a huge edge in this game. Have a great day, everybody, and stay safe trading out there.